So different companies have, say, for example, let's just take the S&P 500 U.S. index as an example. Well, Vanguard has a Standard & Poor's. Vanguard Investments, the big mutual fund firm in the United States, has a S&P 500 ETF.
Okay.
Right? So does Barclays, Global Investors. So they both track, or theoretically tracks, the S&P 500. What these companies say that they attempt at their very best effort to emulate the index, but there's no guarantee. And sometimes, depending on the market volatility, so they have to readjust their exposure all the time to maintain the exact replication rate. Oftentimes...
Now you're saying that's because XYZ company doubled in value because of something crazy, another one went down, so you have to change the stock within your ETF.
The indexer company, indexation company, is having to readjust their mix to replicate the index literally minute by minute.
Yep. Okay.
In some cases, depending on the volatility during a given day, they can be off the exact index by as much as 5 to 7%. That is called tracking error. Tracking error, because it's not tracking the index perfectly.
Okay.
So, and in fact, in Canada here recently, there's been a company, I mean, there's been some issue as to tracking error, in that a lot of these companies, can't, given the nature of markets in recent times, I mean, the volatility level it's difficult for them to be, mark to mark, exact at any given point in time.
How do you do that? Because you don't know. I mean, you'd have to be...
Well, they have computers that actually max it. It's computer traded, right? So they try and balance it out. At the end of the day, they square it off. But intraday, and remember, exchange-traded funds are actually listed on a stock exchange. So they trade minute by minute, second by second on the stock exchange.
Just like a stock does.
Just like a stock. Unlike a mutual fund, which is mark to market, at the end of every day. They do not calculate the net asset value.
Okay, I didn't recognize that. So the mutual fund is ponied up at the end of every day, and that's what the value is. And an ETF is done on a minute by minute, so it's changing like this.
Through the day.
Okay.
That's the...
No, I didn't know that.
Yeah.
So that's
one of the benefits. I mean, the ETF crowd, I mean, I've been talking and working with ETFs for, I don't know, maybe years and years and years. In fact, I was asked some years ago.
They only became popular about 2 years ago, though.
Yeah, I was down in Montreal. I was speaking. Barclays Global asked me to actually speak on using ETFs and managed portfolios, and I flew down to Montreal and addressed a forum of portfolio managers on how to use exchange-traded funds effectively in portfolio management systems. But they've now snowballed to the point where they've become popular for a couple of reasons. One, they're extremely low cost.
Low cost of management?
Right. So, for example, if you take an average Canadian equity fund, large cap mutual fund in Canada, I'm just taking the average expense ratio when you buy a large cap mutual fund in Canada is approximately, last number I saw was about 2 3/4%.
Okay.
Okay, that's the embedded cost within the mutual fund that is charged to you, the unit holder. You don't see that charge.
Yes, okay.
Because it's taken away from the fund on a monthly basis. Yep. It's not the same as the commissions you pay to buy the fund, or if you bought it on a deferred sales charge basis, the monies you'd pay to redeem that fund. This is an ongoing management fee which is embedded within the mutual fund, and most people don't see. Compare this. The average Canadian equity mutual fund management expense ratio is, say, 2 3/4%. It varies at 2.68 to 2.8, but just a hair, under 3%. Compared if you bought the TSC 60 ETF, which is your large cap Canadian thing, is 35 basis points, if I recollect. 35 basis points. That is less than one third of 1%.
Yeah, it's just nothing.
So there's the cost differential compared to a normal mutual fund.
The other one's almost 10 times more.
Right. So, do ETFs perform worse than the Canadian large cap equity funds on an ongoing basis, year over year over year? Well, no. Interestingly enough, most large cap mutual fund managers try to match the index if they possibly can, But Standard & Poor's actually does a study that that measures the performance every quarter, and historically over a several-year period, most mutual funds, 70 to 80% of the time, fail, do less well than the index. So, from an investment,
is that because of the management expense ratio?
That's part of it. Part of it.
Okay.
So, are you better off to buy the TSC 60 index, pay 35 basis points, or buy a large cap Canadian mutual fund, pay 2 3/4% plus commissions?
Okay, I understand. Can a ordinary mutual fund salesman sell an ETF?
No.
I just figured that out.
Right. You have to have a
So
securities
it's not
license.
likely that a mutual fund salesman is going to steer you to an ETF,
Absolutely.
even if that's what you should have.
Absolutely. Because don't forget.
Bingo.
Right. Don't forget, part of this 2.75% expense ratio, in that is a service fee that's paid to the mutual fund
Well, it's a
sales.
trailing
So
fee.
that's the trailer fee.
Trailer fee.
So that expense ratio, and I should make it clear,
So
not
there's no no expense ratio or no trailer fee for an ETF.
No.
But usually, if you're somebody that sells ETFs like you do in a managed portfolio, you're taking a percentage.
right. We charge a fee to manage the account, but you don't have to deal with folks like us. If you wanted to go to a discount broker, you could buy.
You can buy an ETF.
You can go to. What's this new account for? One of the ones discount for $9.95, $9.99. I think it is the latest I saw in this new service Scotiabank's putting out called iTrade or something like that. They're all about the same, $7, $9 a transaction.
We've had a couple of things come in the last couple of days, and I want to mention them. I don't want to particularly mention companies, but even though I feel like I should, sort of. But they both sort of, one is a lady who's in her 80s, and her portfolio went down, I don't know, $200,000 last year, and she received from a big league full-service broker $27,000 or $28,000 management fee for her money to go down $200,000 because they charge a fee for doing it. So that doesn't matter much if it goes up, but it's a lot of money if your money's going down too.
Well, it's one of the things.
I got a better one than that in a second.
Yeah, so. One of the things in terms of good money management for folks is that control the things you can, and you can't control the market, but you can control the costs of investment management. You can control your tax profile to some degree. So it's what's the old saying in life, right? Do the things you can and don't worry about the things you can't control. I forget the exact saying, but
I understand,
in the successful investing, one of the component parts is obviously good tax management. Another one is, minimize your fees. Get the best value for management because fees are ongoing. Markets are volatile. Let me give you an example, David, of the changes in fees over my time in the business. In the 1970s, when I started as a stockbroker, and my boss said, Dan, he said, 1%, if you go out and build your clientele, a fair compensation for you as an advisor is 1% of the value of the account. That's in commissions, not necessarily fees, but if we added up all the commissions over the course of a year, that would be an appropriate and fair return for your time, for you as an advisor, and it's a fair charge for the client, right, for services rendered. So I make the case in terms of costs of management these days is that markets have always been the same. I mean, they go up and they go down. I mean, they went down in the 70s and they rallied through till 81, and then big bang down in 81, up till 1986, and then down in 87, and so forth. So market returns have always been volatile. But get this, the average, as I mentioned earlier, the average expense ratio for a mutual fund, or what I call the super mutual funds, the wrap accounts. Okay, this is where you get the privilege of deploying your money with a money manager who wouldn't take your account unless you have at least $1 million, right?
Okay.
The institutional. Well, the wrap accounts, of course, charge, again, 2.75% to 3%. So investment management fees in general have tripled in 30 years. Rate of return hasn't.
Yep.
So the costs of managing money by the industry have been very, very good. ETFs used properly can cut to the chase quickly and reduce those costs in a very substantial way.